Welcome to the Deep Dive. You're with us for a targeted look at the biggest business stories hitting the market. And today we have a big one.
We certainly do.
We're doing a necessary deep dive into the Q3 FY25 earnings call for Build-A-Bear Workshop, or BBW. It dropped pre-market on December 4th.
And that release caused, it was basically a seismic event for the stock. This is a company that for a while now has had this amazing renaissance story.
Right.
Becoming this super efficient cash-generating machine. But this quarter, that whole story just slammed into a massive wall of macro reality.
And it led to this huge negative market recalibration.
Absolutely.
The stock just cratered. It dropped over 15% right away on massive volume, too. It wiped out months and months of gains.
Gone in an instant.
So our mission today is pretty straightforward. We're going to unpack the material. We need to explain this absolute disconnect between what management was saying.
They were so confident.
And reaffirming guidance. Exactly. The disconnect between that and the market's, frankly, brutal repricing of the stock. And we need to figure out what the long-term future looks like now.
To really get the tension here, you have to start with the headline numbers. It's just classic mixed bag.
It really is.
Build-A-Bear delivered GAAP and adjusted EPS of 62 cents.
Which, was a beat. Consensus was sitting a bit lower, around 59 and 55 cents. So on profitability, they beat what the street was expecting.
That's the good news. Now, the bad news is revenue. It hit a Q3 record, which sounds great, $122.7 million.
Fantastic on paper.
But it still missed the street consensus of $124 million, only by about 1.3%. But a miss is a miss.
And the market punishes misses, especially when expectations are high. But here's where it gets really complicated, and I think this is why the market reacted so violently. Even with that EPS beat, if you look at the raw year-over-year numbers, the diluted EPS fell 15.1%. It was 73 cents this time last year.
And that's the signal. That just screamed to investors that even if they're beating these fluctuating estimates, the core business engine, it's suffering.
It's suffering from structural margin compression.
That margin degradation is the entire story here. How do you beat estimates but still trigger a massive high-volume stock drop?
It's because the market always prioritizes the trend, right? The long-term margin story over a slight beat on a quarterly number.
Always.
Okay, so let's really unpack this. The margin squeeze. Management pointed directly to a huge compression in their Q3 pre-tax income margin.
It was a big drop. It fell from 11% last year all the way down to 8.7% this year.
That's a 230 basis point reduction.
Yeah.
And for anyone not deep in the jargon, a basis point is just 1/100%. So that's a 2.3% drop in how much profit they make on every single dollar of revenue.
So what caused it? The one-word answer is tariffs. Management cited roughly $4 million in tariffs and related costs hitting the income statement. And this was the first time it really hit them materially this quarter. It was a punch to the gut of the P&L.
$4 million is a staggering amount for a company this size, and it wasn't just that, was it?
No, not at all. You also saw SG&A, so selling, general, and admin expenses jump 180 basis points higher year over year.
And that was from things like, higher store pay?
Yep. Rising store-level compensation, higher medical benefits, and just, broad inflation. So they're getting squeezed from the outside by tariffs and from the inside by labor costs.
You really have to understand the scale of this problem because this is why the market freaked out. Management kept their full-year pre-tax income target of $62 to $70 million.
Right. But they had to change how they talked about it. They explicitly said that Target now incorporates about $11 million in total tariff costs just from July through the end of the year.
Okay, help me process that $11 million absorption. That's not a small adjustment. That's colossal.
It is.
If you take the low end of their guidance, $62 million, and realize they had to eat $11 million in pure external costs just to get there, it means the underlying business would have made, $73 million without the tariffs?
Precisely. And the market looks at that one of two ways. Either A, wow, management is doing an incredible job absorbing this brutal cost, or B,
the risk of them missing guidance later is now way, way higher.
Exactly. And the sell-off tells you the market is pricing in sustained pressure. It's the end of that that era of pure upside surprise we've been seeing from them.
Management did talk about mitigation efforts, though. They mentioned some price increases, being disciplined on SG&A, and inventory pull forwards.
And that's why inventory jumped 17.7% year over year.
Yeah.
They were trying to get ahead of the shifting cost structure.
There is one silver lining on the horizon for this tariff, though, right?
A small one, yes. Management noted that next year, the Chinese tariff rates are expected to drop from 30% down to 20%.
So it doesn't make them disappear, but...
But it offers a bit of relief in 2026 compared to this intense pressure in 2025. It suggests the pressure might not keep escalating, at least.
All right, now let's pivot away from the costs, because this is the key to management's confidence, and it's what the market seems to be totally overlooking in its panic.
Yeah, and this is where it gets really interesting.
Despite a rough Q3, the company is still on track for the most profitable first 9 months in its entire history. Year-to-date pre-tax income is actually up 15% year over year.
And that strength is proof their strategic playbook is working. It's all about those diversified, high-margin revenue streams. I mean, yes, net retail sales grew 2.5%, which is solid.
But the real engine is that asset-light commercial and international franchising revenue.
That segment is the star of the show. It grew 4.9% in Q3, and they're projecting it'll grow over 20% for the full year.
Why is that so important to the long-term story?
Because it's so capital efficient. It's high margin, asset light income. It lets them leverage their brand all over the world without having to, build out stores and hire tons of people everywhere.
Right.
When we talk about global expansion, this is it. They added 24 net new locations in Q3, and 70% of those were outside the U.S. There are 651 stores now in 33 countries.
I was really struck by the speed of that. They said they've doubled their asset-light, partner-operated locations just since Q2 of 2023.
It's a rapid, disciplined way to scale. It leverages partners, minimizes their own capital risk. It's the complete opposite of that old, costly mall strategy from 20 years ago.
And they're also using that brand equity way beyond just the workshops. You have to look at the Mini Beans collection.
Oh, yeah, the Mini Beans. They saw over 60% growth in Q3. They're getting close to 3 million units sold.
Management sees this as a huge path for global reach, right? Selling through wholesale independent retailers.
Exactly. They aren't just selling stuffed animals anymore. They're building a whole collectible ecosystem. It's like Funko, but, furrier.
And that taps into their customer base, which is getting so much more diverse. I mean, the multi-generational appeal is just phenomenal.
It really is.
Teens and adults, they call them kidults, now make up about 40% of their total sales.
And critically, that group spends more per visit. The kidult trend appeals to collectors. It gives them more pricing power. They can sell you a tiny impulse buy mini bean or
a $100 limited edition glisten snow deer.
Precisely. That ability to capture nostalgic, high discretionary spending is a massive buffer for them.
It's a very smart strategy. They did hit a bit of a snag, though, in their digital channel. E-commerce was down 10.8% in Q3.
Yeah, that's not great. Management blamed it on tough comparisons from some big licensing hits last year, but a double-digit decline is still a concern.
And they know it.
They do. They're addressing it head-on. They just appointed a new senior VP of e-commerce and digital. They know they need to sharpen their whole omnichannel game.
It's about finding that balance between, what do they call it, e-commerce and e-communications.
Right, using the website to drive traffic to the stores, not just for online sales.
And despite that digital softness and a tough October, which they kind of blamed on the government shutdown noise, they finished Q3 strong.
And started Q4 with a bang. They delivered their best Black Friday in the company's history.
Which suggests the consumer is still there, the brand is still resilient.
And that brings us right back to that fundamental disconnect, doesn't it? If the strategy is working, best Black Friday ever, record profitability, and management is reaffirming their guidance.
Expecting to top $500 million in annual revenue for the first time.
Why did the market panic so hard?
So what does it all mean? The stock was already down over 20% in the 3 months before this, and then it drops another 15%. It feels like investors are totally fixated on the margins.
They are. They're questioning if the valuation can hold up in a tough discretionary retail sector. Zacks has the whole industry ranked in the bottom 29%.
And the market is also laser focused on the short interest. It's high, isn't it?
It's very high, around 18% of the float. The short ratio is about 7.3 days, meaning it would take over a week of normal trading just to cover those short bets.
So there's a deep-seated belief out there that the transformation story is hitting a ceiling because of these costs.
That the $11 million tariff drag isn't temporary. that it's a permanent recalibration of their earning potential.
Okay, we've covered the numbers, we've covered the strategy, but in this kind of volatile environment, you have to ask, what does this mean on the trading floor?
And that leads us to our mandatory high-risk trade idea segment. And please remember, this is purely speculative, it's outrageous, and it is absolutely not financial advice.
Do your own diligence.
Always.
Okay, so what's the setup?
The setup is a classic contrarian play. You have a stock that just collapsed 15% plus in one day on huge volume.
3 to 4 times the daily average.
All while management was on the call reiterating their four-year guidance. The downside here looks potentially overdone. The full known $11 million tariff cost is now completely priced in. The panic might have created an overshoot.
So what's the high-risk pitch?
The trade idea is a highly aggressive, short-dated bull call spread. Or, if you're really aggressive, just a leveraged long position. You're betting on a short-term snapback relief rally.
And a bull call spread is basically buying one call option and selling a higher one at the same time.
Exactly. It limits your risk while still giving you upside if the stock moves up.
And the mechanics of that trade really rely on that high short interest, don't they?
Oh, absolutely. The stock just got violently corrected from the high $57 and down to the low $48. With that 7.3-day short ratio, any good news, or even just the stock finding a bottom, could trigger a brutal short covering squeeze.
So the thesis is that the market will quickly remember the core growth story is still there.
The commercial segment, the mini bean success, the global expansion, it's all still intact.
So you're targeting a consolidation maybe back toward the $52 to $54 range before the end of the year?
That's the idea. You're using that combination of a deeply depressed valuation and high short interest as the fuel. The implied volatility surge after earnings also makes the options a bit more interesting for directional bets right now.
It's highly speculative.
Very.
And once more, that is purely for informational discussion, not investment advice. So, to bring our deep dive to a close, Build-A-Bear is executing its playbook. Global expansion, diversified products, returning capital to shareholders.
Over $26 million year to date.
But that macro headwind from tariffs has finally landed, and it caused a brutal market reaction. The whole story has shifted now from pure growth to disciplined execution under intense margin pressure.
And that leads us to this final provocative thought for you to consider. The company is aggressively and successfully leveraging its brand outside the four walls of the workshop. We see it with the 40% adult sales, the wholesale push of mini beans.
So if they do cross that $500 million annual revenue mark this year, a historic first, while absorbing that entire $11 million tariff cost.
Does the stock at this new depressed level actually offer significant long-term value? Especially when you think about its track record of outperforming the rest of the struggling retail sector over the last year.
We'll leave you to chew on that one and decide if this margin pain is just a temporary wound or if it's a deeper structural flaw. Thank you for joining us for this deep dive.
We hope you feel thoroughly informed about the drivers behind this fascinating disconnect.
We'll catch you on the next deep dive.